Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'm going to interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there. Let's take a look, and let's see what's going on in the social media world. If you want to follow me at finding_finance, and if you want to join our community, finding-value.com, where I dive deeper into these topics, give my opinions more freely, I should say very freely, about individual companies, the setups, technical chart patterns, macro, big picture view things, a lot of training, teaching, and sharing of my opinions about absolutely everything. We do have a coupon code. It is still May Day, MAYDAY, one word, and you can still get that discount, 50% off the first month only, or you can sign up for the yearly membership with a bigger discount. So, accidentally retired says, who's tracking their net worth today? And, I was talking to some of my friends and whatever, and I'll be honest, guys, I don't track my net worth on a day to day basis. Some people will say, oh, you just log into your account. I've got like 6 accounts. I go into one of them, which is my largest account that I consistently add money into and where my self-employed 401k is at. But my other 401k, actually, there's multiple 401ks that I still have that are not integrated into one area. I very rarely go in those. I don't add anything into them. And my wife also has a 401k as well that I hardly ever go into. I did put a lot of money and change the investments in September of 2020, where I moved into oil, into uranium as well. And she's got like a oil, gas, uranium portfolio for the most part. And then the dividends collect in there. They're not very big dividends, so it's not like I'm in there and I need to be in there all the time. So with all of that stuff, I can't even tell you how many ounces of silver I own. I probably can't even guess within a few hundred ounces. I just don't track it. And there were long times in 2018 that I was just buying silver, like high premium silver coins for super low premium. So I was buying like Chinese pandas, I was buying kookaburras, and people were offloading this stuff because it was basically at the bottom for like 99 cents over spot. So people were like, oh, I'll give it to you for spot or a little bit over spot. And I was like, all right, I'll take whatever you got. So I bought American Eagles. I bought Canadian Maple Leafs. I bought Chinese pandas, kookaburras. I bought everything like within like a dollar of over spot or at spot from individuals all over the place. I even got like older Chinese pandas like '04, '05, '06, '07, '08. And they were like really close to spot price. And I was like, all right. And I just loaded up when nobody wanted it. So yeah, I don't know. I'm not tracking my net worth. Probably I could probably guess within $100 or $200,000 of what my net worth is. I could probably guess within that reasonable um, standard the deviation from it. Blind Luck Project says if you had 100,000 cash and had the option to buy land, house, or invest it, which I kind of think buying land or house is investing to some degree, what would you do? The goal is to build wealth the fastest possible way. Well, I mean, I think it depends on the person and the situation you're in. If you don't own a house, you can buy a house with $100,000 down or $80,000 down or whatever you put down on it. Get a loan, which is a leveraged way to play something. So you've got exposure of a couple $100,000 above the $100,000. So you're playing a leverage game. And another thing that you can do if you buy a house is you can lock in your mortgage. You can always refinance later, lowering your payments. And then you can also rent out the rooms in the house to basically pay off the mortgage. So you can live somewhere for free. If you bought a 4 bedroom, you can rent 3 of the rooms out. You can probably rent them between $500 and $1,000 each. You can probably cover your entire mortgage payment. You have a leveraged play to real estate. And I think that would probably be a pretty decent bet if you don't already own a house. If you own a house, then you should be renting it out anyway. If you are in your 20s or something like that. And that's what I would do if I could do that. Now, if you already own a house and you had $100,000 in cash, well, then I would invest it into other things, and make sure that your costs are locked in with a fixed rate mortgage, and then invest it in whatever you want. Now, it depends on what you want. Do you want dividends? Do you want to be risky and try to swing for the fence? Or do you want to kind of play somewhere in the middle where you do a little bit of both? What I found the sweet spot is in the middle. You don't want to go full risk and you don't want to have no risk, because there's risk in having no risk, and that is your returns lag. So I think there's a sweet spot in the middle, and that's where I try to play it, is that sweet spot in the middle where you've got good upside returns and a high probability of that occurring. So that's what I think is the way to build wealth the fastest possible way is if you buy a house, you can increase your income by basically leasing out the rooms. So your income goes up. That's what I would do first. If you own a house and you're already doing that step, then I would invest it and I would go for the middle of risk reward and probability of success. Andrew says, a Roth IRA is the most powerful investing account in America. The Roth IRA limit is $7,000 in 2024. That's only $135 a week. Invest that money into an S&P 500 index fund. In 30 years, you'll have invested $210,000. However, the account should grow to $1.3 million of passive tax-free income, assuming a 10% growth rate. That's the power of tax-free growth and compound interest. There's other methods that you can also use outside of a Roth IRA. You can do a Roth 401k if your employer offers that. And depending on how much money you make and the situation that you're in terms of taxes and your deductions, you may want to do a Roth 401k if you get a company match, to at least get the company match. If you feel like you're make too much money and you want to reduce your taxable income, then a regular 401k would also work. You can also, on top of it, do a Roth IRA. In a Roth IRA, they do limit how much money you make. It's up to, I think if you're married, it's like $250,000 a year. So if you make more than that, you can also put money in an individual IRA, just the regular one, and then do a backdoor Roth IRA because it's after-tax money, and convert it over into a Roth IRA, getting around the 250, whatever it is, limit that there is. You can also do this if you're self-employed and you have a 401k. You can put money into your 401k after tax up to a limit. That limit, I think, is $69,000 for employer and employee contributions. Then if you put it in after tax and they allow you to do this, they either consider it a Roth or a Roth 401k, or you can convert that after tax money into a Roth IRA account. And that way, you can put the max limit of pre-tax money, which this year I think is $23,000 per individual. So you can reduce your taxable income by putting in the max. And if you are aggressive, you can also do an employer match. Depending, I think you can go up to 25% of the income that you pay yourself if it's an S corp. So if you pay yourself $100,000, you can put in $25,000 pre-tax. So now you're up to, $58,000 to reduce your taxable income. And then you can invest the difference, $69,000 minus 58, which is $11,000, into a Roth 401k or into a 401k after tax and move it into a Roth IRA. And you could do that the same year or the year after, either one. So there's all these options to grow your money in a tax-free account. You also can have a health savings account where you can contribute $8,300 per family, which is it reduces your taxable amount by $8,300 and it grows tax-free. The strategy I had deployed there is I maxed that out in the health savings account, and then I get dividends from my investments in that account, and it can also grow. And I use the dividends to pay off my healthcare expenses. Another thing just to think about, you can acquire healthcare expenses and you can pay yourself back years later as long as the account was open when the expense occurred in the health savings account. And it has to be a health-related expense. So I could take if there was expenses, I can take those expenses as long as that account was open during that time. Let's say it was in 2022, and I could take withdrawals out of the account for those expenses in 2024, 2025, whenever it is. And that's what I'm doing with mine. I'm building up the account in my health savings account to use the dividends to pay me back for as long as those expenses remain open, is what I'll call it. And I'm not a tax person, but that's some of the things in my opinions of what I'm doing around all of that. So Lance Lambert says, this Fortune 1000 home builder believes that hybrid work represents a long-term tailwind for the home building industry. In my opinion, the long-term tailwind is the big demographic and family formations of the millennials that is going to drive new home builds to the upside, and it's larger than the 1970s. We also have a greater imbalance because we didn't build all the homes after 2011. We had a huge drawdown in new build construction. So we also have the imbalance and the deficits from that on top of family formations that are growing faster than the average. That is what's going to drive this cycle to levels that could be higher and potentially longer. RevCap says this is actually encouraging in theory. If you look at what they're proposing in practice, you may want to jump off a bridge. A huge slush fund to renovate public housing, like that will work. So just focus on the theory, the vibes of caring. So this is coming from the White House. This is what they say. It says housing costs less when we build more of it. That's why President Biden is calling on Congress to pass legislation to build and renovate more than 2 million homes. It says the bottom line is we have to build, build, build. That's how we bring housing costs down for good, says President Biden. And that will also drive the cycle. If we build, 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 that means that we get new loans against new homes. And that is what expands the M2 money supply. That expands your credit from a monetary perspective. So if they lower rates into this demographic and deficits of homes, it's going to bring the affordability right into first-time home buyers. And if they build, 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 I don't know if that's going to lower the housing prices because it depends on what the break-even price is for home builders. They can build smaller homes. They can build townhouses or something, but I don't think they're going to lower prices below their break-even costs, which I think are rising from inflation. But that is the cycle, guys. This is your business cycle. And when we go to an expansionary phase, that's when commodities take off. They're going to rip. And commodities are all aligned for that to occur. They are all aligned for this to occur. Unpopular opinion, an $80,000 a year job, that's 40 hours a week, is better than having an $80,000 a year business That's 80 hours a week. Your time is worth more than you think. There's nothing wrong with having a 9 to 5 job when you like the work and have a great work life balance. Time is greater than money. The one thing I'll say there is, I think it depends because if you're in your 20s and you're just building the business and you make $80,000 a year and you're working 80 hours a week, that may not be the equivalent of $80,000 a year at a 40 hours a week. Yes, that particular year that you're looking at may not or may look like it's favorable for a 9 to 5 job. But what if you look at the forward trajectory of that business and the earning capability, and then eventually what the payout is when you get older? So you might put a bunch of work up front for very little money, but it pays you off in the back end. So if you're working $80,000 a year job and you're doing 40 hours a week at a 9 to 5, what is your potential 10 years from now or 20 years from now? Are you going to be making $120,000 10 years from there? And then your business, what if that shifts and in 10 years you're working 20 hours a week, but you're making $800,000 a year? So I wouldn't look at this. A lot of people, they're so static in their thinking. You have to think in the future of your strategy, your goals, and be realistic with the potential outcome, and if you're going to be happy with that outcome. So I don't look at just today. When I was in my 20s, I didn't look at my day-to-day living and say, well, you know what, I'm saving money and I should just be blowing it all on stupid crap that doesn't really increase my standard of living. Buying a car that's $7,000 that I purchased, it was 7,000 something dollars when I first purchased my first new car. It was just a little Chevrolet Aveo. That's all it was in my 20s. I was like, I just need A to B transportation. And would that have been a big difference if I had purchased a Mercedes at $80,000? No, it would have been the same. My standard of living doesn't go up because I drive a more expensive car. My standard of living only goes up for things that I can eliminate out of my life that I don't want to do versus things that I do want to do. So if I can do more things in my life that I want to do and eliminate the things I don't want to do, that is an increase of my standard of living, in my opinion. And again, this is all opinions. So a 9 to 5 job, in my opinion, going 40 hours a week is a big pain in the butt, especially if you think that you're adding more value than what your manager thinks. Then there's all these limitations on moving up at those jobs. I don't want those limitations. I hate that. I grew up in playing, and we'll get to it a little bit later. I'll dive into it a little bit later, but I don't like having those limitations. I don't like being squared into something where you get a certain raise based off of your performance and how long you've been there. I don't like that. It's stupid. I'm about to have Tourette's here, guys. I hate that. So we'll keep moving on. Larry Thompson says, CCJ, early favorite from Monthly Candle Review. This thing looks like it's ready to go for CCJ. It's breaking out to new all-time highs. And as you break out to new all-time highs, you know what occurs? Less resistance from previous trading action. So there's a lot of resistance where that reddish line's at, and we have cleared that resistance area. My latest chart on Focus article, the uranium blow-off being echoed by gold, is posted at here. So gold is the leader. So this is log of cash gold prices on monthly data. And then you've got log of uranium prices in the red. And you can see gold leads it. Here's the leading move in 2016, and it's lagged in 2017, 2018 for uranium. So another thing to think about is gold and silver has been running here. Gold's the leading indicator for the most part, and it's probably indicating liquidity or something like that's coming into the system. And then uranium, oil, and these inflation-sensitive assets, they lag gold by about 18-ish months. So we're probably going to see a big move in oil, a big move in uranium that is coming here soon, I would say. Is this the second half 24 playbook? This is little value versus big growth. And little value could start to outperform big growth. We can see that there's a divergence in this RSI at the bottom here. So we could definitely see a double bottom here where little value starts to outperform big growth. Big growth being those big names like Nvidia, stuff like that. We could see a rotation into small cap value. David Marlin says, in the first 5 months of 2024, over 80% of all equity inflows have poured into tech. The only other sector with year-to-date inflows is industrials. So this is your inflows, and you want to tie this with this. The chart pattern is how money is about to change. You're trying to look for an inflection of a changing move. Value is tied to energy in a lot of this. So if energy and some of these other value stocks start to get money flows, I think money is going to flow from technology, big growth, into potentially energy here. And interest rates and that big cycle that we were talking about earlier in the home builders, that's what's going to drive the cycle. Every single time we've gone into a large expansionary phase of homes, every cycle, guys, not just one, every stinking one in history, we've seen money rotate from technology, which is in a bubble, into energy and other commodities, and precious metals, like we're showing here. And gold's the leader of that money rotation. So if gold's already going up, we should be looking at uranium, and we should be looking at oil and nat gas and energy service and all those different areas. That's exactly what we're looking at on the website. So this is what I'm talking about here. So energy stocks are printing fresh 4-year highs relative to crude oil, and this is XLE, the big boys. I like the smaller stuff, but XLE is also an indicator of what's going to move and when it could move. So we're basically at a resistance level that we've been at for over a year. And I think we're going to break out here, and we are just barely breaking out to a new 4-year high here. So I think energy is about to take off. I think there's some good opportunities in energy right now. It's the truth, Steve Wagner, and get rich quick, and then you've got the slow and steady gains. Now, here's the thing. Commodities are not necessarily slow and steady. What occurs is, and it really depends on when you buy it, if you can get at a really low price, you may need to be patient in the front end, where you get in, it's real low, you might have some moving sideways and not really getting huge gains right at the beginning. Then it rips, where you get decades of returns in a few years. So you need a time horizon that will capture that big move. You will get rich quick, and you will get rich quicker than other methods. It's not like weeks, though. And these people all get decimated because what they do is they chase price instead of chasing value. Value is where the big money is made. It doesn't mean it's slow and steady. It just means that you're buying it with a margin of safety, and then you're waiting for the right market conditions and the people to kind of realize, like, wait, this is all changing into these investments that we are in. The get rich quick people, they just run after price. And that's where you get slaughtered. You get slaughtered when you don't pay attention to the value and you run and chase after the price movements. So people are going to be running into Nvidia. That's where the price movements are very advertised and seen. But I'll just say this. Whenever retail is running into something, you're close to the slaughterhouse. That's what I'll say. And here's Apple. Looks like it wants to kick off June with a bang. So I do look at charts. This is a shorter term chart. And we could get a move higher in Apple. But I thought that I just said that technology will eventually rotate over. It will eventually. But that doesn't mean it will be immediate. So these things will overlap. You could see some positioning, the smart money positioning in commodities. They're going to be putting in bottoming patterns, which we're doing right now. But when we start to enter from stage 1 to stage 2, which a lot of the commodity stocks are doing in stage analysis on the big long term, these will start to roll over eventually. And it's going to suck in money to energy in some of these other areas. But tech right now is hot, and it makes me think that we're earlier in the cycle because we are still in the end phases of a technology bust. Boom. The end phase of a technology boom, which will turn into a bust. But it'll take time. We might still be 6 months to a year or two out from this bust occurring. The real thing I don't get about silver is the purpose of buying either is to, in theory, preserve a given dollar buying power over a long period of time. So let's say you want to save $10,000 in the form of precious metals. Why are you buying the one that takes up more space? Well, this guy, obviously, I don't know why you would even say this, but my opinions around this is silver is not a good long term investment. But during certain periods of time, silver does ridiculous things. So you want to be in it for the possibility of catching one of those ridiculous moves. We look at the chart. Silver's got a 50-year cup and handle. It's breaking the handle portion midway, the downtrend of the handle right now. Yes, it's going to take a little bit of time to maybe break the final resistance levels above us. But when it runs, guys, it's going to run massively. So silver is going to run massively, but I don't think that gold will necessarily do that. It could run, but I don't think it's going to run as fast as silver. We can also see that in the gold to silver ratio and a lot of these ratios that we look at. So really, this guy is basically saying that he doesn't understand the silver market and he doesn't understand investing perhaps at all just in general is the way that I would read it. Trader says copper. Copper's had an outstanding month. And I'm just going to go straight to the chart. I know he's got a lot of verbiage there and narrative, but we basically come into resistance. We're right at that resistance, and we are slowing down, and we can see a little bit of maybe a handle here that gets developed. But either way, we're going to be breaking out of this thing, and it's a gigantic base. We have a long, long runway to run here. And once we break through that resistance level, whenever that is, we're going to run Forest Run. It's going to be an incredible opportunity for those that want to partake in these investments here. Mike Zaccardi says millennials' net worth was $5 trillion in early of 2020. It's 13.5 trillion today. So the millennials are definitely stepping up their game. But in all honesty, guys, I mean, wealth and your worth, it's going to go up as you age. Doesn't really matter. All the rich people are going to tell you they'd rather be young and broke than be old and wealthy. So, I mean, does it really matter? I don't know. I mean, I'd rather be young if it were me. And I'd rather have little money and be really young, like 20 years old again, 18 or whatever, than be rich and be 60, 70, 80 years old. And they'll all tell you that. Everyone's going to tell you that. The Happy Hawaiian says some people get really pressed at these stats, including home equity. I'm not sure why it shouldn't count, but here's the millionaire stats excluding home equity. And I don't know how they determine these stats, but so you're one in 100 if you're a millionaire between 18 and 29, and then you can see 1 in 5 people if you're 55 plus. I'm 42, so that puts me 1 in 14. So I'm 1 in 14, I guess, being where I'm at. Logan says you're looking at people who say existing home sales lead to a recession, but that isn't the correct data line because that is more of a transfer of commission model with a small portion of labor force. Construction workers have a better historical value. Completely agree with that. And all employees for building residential construction continues to go up. So no recession, guys. Existing home sales. And I'll let you guys know what this was in response to. It's a few threads below this one. Saudi energy minister, they deliver. OPEC Plus extends group-wide cuts through 2025. Reports that extra voluntary cuts to be extended through 2024. Waiting on individual company announcements. The UAE gets an added allotment of 300,000 barrels per day for a phase in 2025. So are we going through a slowdown here? Why are we extending these cuts? Or are the cuts a further problem that maybe they can't raise production up that much? And I am surprised that we're in the $70 a barrel. This is incredibly cheap, guys. We're at a gold to oil ratio of 30.5. Such a great deal here for oil. It is unbelievably cheap. And we're at 70 something bucks a barrel here. Insane. JC Parrott says, do you think playing baseball for many years teaches a certain level of patience that can then be applied to other aspects of your life? Yes, I do. I was in sports. I played baseball. I played hockey. I played soccer when I was really little. I played a little bit of football when I was in elementary school, and I didn't like it as much. But I really liked hockey. I really liked baseball. I played on all the all-star teams. I was on Team Minnesota for hockey for many years, um, all the way up to about high school. I think they go up to like 16 years old or something like that. And I played with the best players in the state, and I played against the best players in the nation and in Canada. I would travel and do all that. So the one thing I learned, and one of the things I walked away with was um, a, a lot of everything, there's a lot of things in life that I come across that are just not that competitive. When you go through that type of competitiveness and you're competing against people who are going to go professional, pro, either at baseball or in hockey, and you've got Division I scholarships, they're worth $250,000. Some of these guys, they throughout their career, they made, 30, 40, $100 million in hockey that I played with. I think I played with maybe 5 or 6 professional hockey players growing up. When you suck, they were going to tell you that you suck. They're going to tell you that you need to improve, that you need to work on. It builds in a stage of humbleness, and it builds in a work ethic where if you want to go somewhere, you can work for it. I don't. I never got that in school. That almost like unfiltered, response, and then you have to do something with it. So I think it makes you tougher, and I think it makes you mentally better to take on more difficult challenges. Then you also look at the techniques and strategies to become better. And you can also apply that in business, and business is like the worst. Business is more about who you know than your actual talent. Well, at least at the places that I've worked at, which are the big boys. But I think you can apply it to a lot. And it builds in a lot of toughness. And then when you go and you look at other things, you just look at this and say, this is so dumb. Like I've already kind of played it like the pinnacle of like the best players and playing all these best players of, whether it be like all-star teams from different states, from different countries. I played a bunch of all of those different teams. And then I look and I go into business and they're like, well, how come, how do you run a high performing team? I'm like, guys, some people just aren't like, they don't cut it. That's what it's like. And the way that they pay is even worse because, I mean, if sports, like if you're really good, they will pay to retain you. It's pretty obvious that customers or viewers want to watch certain people and they should get all the money. It's the way it is. It doesn't matter if you're 25 years old and you just graduated from college or something like that. They're going to pay you many, many millions of dollars to do it. In a big business, they don't do that. If you're really good and you're 25, 26, 27 years old, they're not going to pay you a bunch of money if you're at some of these big corporations. And that's the biggest upset that I have is I went through all of that competitive, training, so to speak, in sports and in school. And then you get out and then you work with a bunch of people who aren't that smart and it's not very competitive and they don't pay for crap. So, I'm in the camp. It's like you got to get out of the 9 to 5 somehow and go into a more competitive spot if you want to make a lot of money. Maybe go into sales or maybe go into something where you're not capped on the upside so much. And that's if you're really competitive and you grew up with very competitive people who are very smart and competitive in terms of athletics too. Tavi says today it costs more to buy a Big Mac in developed countries than most emerging markets or less developed economies. The last time that we observed a similar phenomenon was in the early 2000s when emerging markets investments significantly outperformed developed markets. So I agree with that in terms of emerging markets that are about to outperform. And that also coincides directly with the real estate cycle and building all those homes. Every time we had these big real estate booms, emerging markets have eventually outperformed when the dollar drops. Think of a declining interest rate environment after raising interest rates. This is the one that that we were talking about that was a response to. It says this chart looks very concerning. The housing market's been an accurate leading indicator for the unemployment rate, and it's anticipating a sharp rise in unemployment in the coming months. It actually doesn't. You want to look at construction workers. Construction workers is where the bulk of the unemployment comes from, and that's the cycle. It could go up like the 2000 here. So in 2000, if we go back up to that construction guy here, in 2000 we had a little bit of a pullback in the mid-cycle wobble, we'll call it. We don't see that. Oh, sorry, I'll stay on this. We don't see that yet. So I think we're going to be higher for longer in terms of interest rates, and I don't think we're going to get that recession that everybody's worried about. You have to look at the right data and then make the correct conclusions from that data. So this guy is close, but he's still off. Even though he's got 206,000 followers, I just don't think he's nuts on yet. And that's where I'm going to end it, guys. So that's what I've got for today. Thumb up for the content, subscribe to the channel, and yeah, that's all I've got. So we'll catch you later. This is Finding Value.